Welcome back to another Meet Kevin Report. We are on episode 55. Today is March 18th. 55 days in a row. It's been a blast. Let's keep it up. So, a lot of stories to cover today. Gosh, I feel like I'm pretty sure I say that every single day, but that's because there's just so much craziness going on. We'll go into a little bit of the background around this Trump arrest you may have heard of, the Putin arrest you may have heard of. Like, what? Okay, like, two massive names just happened to drop yesterday. We're going to be talking about bail-ins, risk of a depressionary recession. We'll talk a little bit about what Janet Yellen's up to. We'll talk about what's going on with the Federal Reserve as well, which is going to be a big deal. And we'll take a look at what our boy Nick is up to. He's got some talking he's been doing. So we've got a lot to talk about. And I think the easiest way to begin is just by beginning. All right, so let's get started with the first one. The first thing we're going to talk about is bail-in. So this is going to be really interesting because usually we think about bailouts, right? So let's talk bail-ins. All right, here we go. Okay. There's now talk circulating about a $2 billion potential bail-in for Credit Suisse. And what we've got to talk about is how this could affect. Hold on a sec. My bad. It's 82 billion. It's such a big difference. Of course. Why did I say two? Oh, hold on. My bad. It's Saturday. You know what? The first coffee hasn't hit yet. Actually, it's too hot for me to even drink. Does anybody else have that problem where if you have black coffee, it comes out of the machine way too hot? You got to like mix it with stuff. Anyway, all right, here we go. We got to talk about an $82 billion bail-in for Credit Suisse, how this affects Americans, and will it be enough to actually stabilize the drama that's going on at Credit Suisse? We know that the Swiss National Bank just over the last few days injected over a 54 billion US dollars, about 50 billion francs, into Credit Suisse via basically an emergency loan. But now there's fear that a potential bail-in will have to occur, which could lead to such losses elsewhere in the economy that potentially we could see other corporate failures or bank failures. Now, this is interesting. So we've got to understand what a bail-in is and how it is different from a bailout. First of all, what's happening right now is really just an emergency sort of alarm bell that the bank is knocking on the door of potential complete collapse. When we start talking bail-ins, I want you to kind of think about it like this, okay? Normal operating company, bail-in. That's kind of like your one of your initial red flags, and then a big gap, and then either failure and bailout or failure and no bailout, right? So bail-in is generally first in the row, and it's seen as sort of an alarm bell of what's potentially to come. And so Credit Suisse actually holds special types of bonds that become affected. Now I'm going to simplify this. Let me give you the data first. So the bank currently holds about $82 billion of bail-in bonds and Tier 1 notes that are already trading at distressed levels. And so here's how this works. In the event that a regulator, beyond this emergency loan that Credit Suisse already got, okay, you've got operating, you actually have the Swiss National Bank already coming in, providing an emergency $54 billion loan to this company. The next step would be in the event a regulator steps in to help protect the Credit Suisse depositors, you're instantly going to see bail-inable, it's a mouthful, bonds get written off, and bail-in senior holding debt would become equity. So that sounds really fancy, but I'll simplify that. Bail-inable bonds were introduced by European and Swiss authorities to make sure that taxpayers wouldn't end up being on the hook for banking failures. And that's a big deal because that's what we're debating in America. Everybody's pissed after the failure of Silicon Valley Bank that there's a potential that the facility that's being used to basically protect the depositors at Silicon Valley Bank is backed by taxpayers. In other words, if the Federal Reserve and Treasury lose money, the taxpayers are the one who have to pay for it. And that is very frustrating because a lot of people see that as sort of the 99% bailing out the rich 1% who have connections in Silicon Valley, including the governor himself who banked at Silicon Valley Bank and was begging the White House to bail them out. Doesn't seem very just, but bail in a bull, that's such a tough one to say. Bail in a bull bonds were introduced exactly to try to prevent taxpayers from taking a hit. So that's a big deal. And what they did is they introduced these fancy acronyms as sort of like shock absorbers, and they called them AT1s. They were introduced after the financial crisis. And basically what happens is after a regulator steps in to protect depositors at Credit Suisse, when and if that happens, anybody who owns that debt basically has their debt become worthless. So let's draw that out to make that even simpler. It's basically an instant eradication of an obligation to someone else. And it might be easier to see that visually because these bail-in-a-ball bonds are kind of crazy. But they're useful, again, to protect taxpayers. So think about it like this. Let's say you hold this piece of paper, and this is a note. A note is a fancy way of saying, I owe you. That's where these terms came from, basically. Like you handed me a note, and it said, I promise to repay you. A promissory note. I promise to repay. Anyway, let's say this note is worth $1,000. And you have the note. And who has the $1,000? Credit Suisse got the $1,000. But Credit Suisse has to pay that back to you with interest. And so on the side of Credit Suisse, this looks like debt. On the side of the person who holds the note, it looks like an asset. And so what European regulators say, and this is different from what we have seen in most banks in America, what European regulators say is, look, if we come in to protect depositors at Credit Suisse, the first people we want to lose money are the people who hold these notes right here, these IOUs. So what we're going to say is before the taxpayers pay a dime to help Credit Suisse, what we're going to do is we are going to delete the existence of these notes. That means these people, these bondholders, lose their asset, but Credit Suisse loses that debt. Now, that's actually critically important because banks operate with certain statutory minimum capital reserve requirements. It's basically like saying, hey, if the bank has $100 in deposits, they need to keep about $10 in the bank and they can go play with $90. That's about a 10% capital reserve ratio, right? There are ratios like this that also apply to how much debt a bank is allowed to have. So if a bail-inable bond can be eradicated, it serves as an early warning sign that the bank is potentially failing. And it helps mitigate some of the pain potentially, and maybe even prevent failure by eliminating that debt the bank had, at least some of the debt that the bank had, potentially up to $82 billion of such debt. Now, what's neat about this is, again, A, it protects the taxpayer, but B, it potentially prevents the entire bank from actually failing. The problem is, or I guess maybe the early problems that we're seeing now, is people who hold those notes, they're like, oh crap, I might lose my entire note. So in other words, let's say you held this note on this side. Let's say you held this $1,000 asset and you had an IOU. What would you want to be doing with that right now with all this news circulating about Credit Suisse? If you held that piece of paper, you might be like, man, this is becoming a toxic asset. It might go to zero. Well, if something has a risk of going to zero, what do people usually do? They sell it. And that lowers the price of those assets. Right now, Credit Suisse bail-in-able debt is trading at just 66 cents on the dollar. And that's a sign that people actually think this bank has a real chance of going bankrupt. Now, this is all divided into multiple different tranches. You've got about $35 billion of CET1s that would be at risk first, $16 billion of AT1 debt afterwards. Then you'd have about $59.8 billion of francs that are bail-inable, senior holding debt that converts to equity, or some of the debt would convert to equity, not necessarily all of this. That potentially means even more downward pressure in English, means more downward pressure potentially on the stock. Because if more people have their debt turned into equity, which not all of them are, some of those bonds are just deleted and they disappear. The people take a full loss on them. Some senior debt just gets converted into equity, which is basically a stock, the share. And now you have a share, and people might say, well, I don't want these shares. Dump them. Well, now you drive the price of Credit Suisse stock even lower. And when you drive these bonds to zero or Credit Suisse stock down, what ends up happening? Other banks stop trading with you. And that's exactly what just happened with Credit Suisse. Other banks have stopped wanting to do business with Credit Suisse because they don't trust Credit Suisse anymore. They think if Credit Suisse goes down, then they're not going to get their obligations repaid. Consider, every time a bank does business with another bank, there's something called counterparty risk. It's just a fancy way of saying, look, if I lend somebody something overnight, well, what if they go bankrupt overnight? I might not get that money back. That's counterparty risk. Or what if I deposit my money at a small regional bank and I deposit more than the FDIC limits? Well, if that bank goes bankrupt, my counterparty risk is not being able to get my deposits back, right? That's a simple way of explaining what counterparty risk is. Obviously, there are many complicated examples. The issues here with Credit Suisse are that this bail-in event could end up having a massive ripple effect where, because all of these banks owe each other money, you could end up seeing more defaults and potentially hedge funds or other banks. And those end up having a cascading effect, leading to potentially more bail-ins, and then more collapses, and then more potential bailouts, more runs on the bank, more fear, and ultimately more money printing from the Federal Reserve to try to stem the fear that's occurring. When we print more money and we expand the money supply, eventually we're likely to create more inflation. So the bail-in issue that's being talked about for Credit Suisse and the potential collapse of Credit Suisse could create the contagion that everyone fears. Now, I want to be very clear. This is the next level fear point from the Buy the Fed Pivot facility. That's not actually what it's called. That's what we nickname it. But I want you to kind of line this up for a moment. So think about it this way. So you have a normal operating bank and you have a normal operating bank. When there are problems in America, we now have the Buy the Fed Pivot facility. It's like the Bank Term Funding Program or whatever is what it's actually called. We think this could potentially inject up to $2 trillion of liquidity into the banking system via the Fed leveraging up their $125 billion facility. That's almost a 20-to-1 leverage. In Switzerland, you have the Swiss National Bank that's come in with basically a $50 billion direct loan to Credit Suisse. So it shows you some of the differences here, right? We make a program and we say, hey, you could borrow from this program. In Europe, the Swiss National Bank is basically saying, we'll just give you a loan directly. Okay, that is sort of your first level defense for bank failures. The next level, if we draw this out, would in Europe basically be a bailout, a bail-in rather, like we've talked about here, a bail-in. Then we potentially have an acquisition, which could be an idea on the left side as well. And then you potentially just have failure along with potentially bailout. So put that in. So this is kind of your order of operations for these banking failures. It's worth noting that right now Deutsche Bank is looking into potentially acquiring parts of Credit Suisse. There's talk that Deutsche Bank is looking at segments like the wealth management division to potentially get the clients who actually still have their wealth, whatever's left of it, managed by Credit Suisse. But keep in mind, a lot of these banks have many, many different departments and divisions. They have generally an investment banking division where they can do trading. They could have an IPO division. They could have, like I mentioned, these wealth divisions where people are like, hey, I got $10 million, help me invest it, or whatever it might be. And then they get fancy white glove service for mortgages, airplane loans, blah, blah, blah. You know, that's kind of like the fancy banks want to do everything that they can in their power to maintain their fancy clients, because their fancy clients is where they make a lot of money, right? So they'll do whatever they can to take care of those fancy clients. And usually those fancy clients are less of a risk than obviously a startup, because these people have already made their money. That's where, for example, Silicon Valley Bank went wrong, right? Because Silicon Valley Bank was only pretty much lending people. Well, I suppose they were also lending money to people that were quite wealthy, but they were pretty regularly lending money to individual startups that had no cash flows. I mean, I was looking on Twitter and I saw one VC was talking about how, hey, if we we will write $100 to $500 checks for businesses that have anywhere between $20,000 to $50,000 in revenue. And I'm like, $20,000 to $50,000 in revenue, that's so low. Like how that business is massively negative cash flow. And apparently those types of businesses are still actually getting investments in this environment. It's insane. So if VCs are doing that, imagine what some of the banks were doing, especially like a Silicon Valley Bank. It's crazy. But this gives you an idea of what a bail-in looks like. And really, the more you hear about this potential bail-in over here, what does it mean? It's more of a red flag that things are basically getting worse for the banking system. It's kind of like saying, hey, our credit default swaps are trading at a massive premium because we're probably going to go bankrupt. Credit default swaps are just basically an insurance. We used to use these a lot in 2008, CDOs, collateralized debt obligations, credit default swaps. They're derivatives. They're like fancy option contracts, off market basically. Well, I mean, there's a market for them as well, but it's not sort of in the markets that we generally play in as retail investors, more of the institutional markets. And when the premium for these goes through the roof, like 3,000 basis points up somewhere around 30 to 300x, which is what we've just seen over at Credit Suisse. Oh, it's a sign the market's thinking, okay, y'all are knocking on the door of bankruptcy. And it's scary because it's not just Credit Suisse, but I was talking to course members yesterday in our course member live stream, and we were looking at the credit default swaps, the pricing for them for Deutsche Bank. Deutsche Bank has been struggling for this last decade through scandals, and Credit Suisse isn't an angel either, okay? Credit Suisse lent money to businesses that failed, like Archegos Capital Management. They're also, by the way, being sued for claims of fraud in 2018 about purposefully trying to basically destroy an investment vehicle so that the bank could profit. This all had to do with claims of losses of around $1.8 billion around February of 2018 through these notes called XIV notes. Those were notes that basically went up when stocks were calm and went down when stocks were volatile. So it was sort of like an inverse volatility play. And Credit Suisse is being sued over potentially rigging that investing instrument. So Credit Suisse is by no means an angel, but neither is Deutsche Bank. And their credit default swaps are flying to the moon as well. They are priced just about as high as they were priced back in October. So it's not as ridiculously extreme as Credit Suisse. But in October, people were fearful that Deutsche Bank was going to be one of the first legs to fall. Now, they didn't end up being one of the first legs to fall. Instead, we got Silvergate, Signature, Silicon Valley Bank, now fear over Credit Suisse. But this contagion could really keep going. Now, this is leading Biden to demand more punishment for these sorts of executives in Congress. I doubt he's going to get anything done, though. Listen to Fox. They're even talking about it.
Plummeted yesterday with First Republic closing 33% down. You can see there it dragged the other regionals with it. Now, for some context, the regionals are under pressure as they have similar risk profiles to SVB. That's problematic as small businesses and communities across the country depend on them. With comparisons to 2008 looming, we asked Americans how they're feeling.
But it is a little scary to know that these smaller banks that aren't all that small could have a trickle effect and affect the entire economy.
If banks feel like they have an insurance policy, then there's really no incentive for them to clean up their practices.
We got to pay the taxes to prop up these companies again, and we should. Yeah. If it's going to fail, let it fail.
So you're really hearing that fear of contagion, and Neil, in practice, that fear could end up being just as dangerous as an actual liquidity problem. Back to you.
Thank you, Kelly.
Yeah, what the one individual said about, let the banks fail is actually a very capitalistic point of view. It's like, why should ordinary Americans have to bail out a bank like Silicon Valley Bank? Now, of course, you get all of the stories about like, oh, I'm a small business owner or whatever. I got my money at Silicon Valley Bank. I've got 12 employees. I'm going to have to lay them off or whatever. These are the stories you hear, right? If I can't get my money out of Silicon Valley Bank. People wouldn't have lost 100% of their deposits at Silicon Valley Bank. Their assets would have been liquidated, and maybe it would have been a 20 to 30% haircut. Some say maybe even as little as 10%, although I doubt that because there would have been a fire sale in the bond market, which would have led yields to rise. Then financial conditions would have tightened, which is exactly what the Federal Reserve wants to limit inflation. But no, instead, we've basically de facto guaranteed nearly all deposits at relatively larger banks. So there's no such thing as FDIC insurance anymore. It's just you're fully insured if you're at one of the big crony banks, which, look, I mean, you can't blame anybody for going to a big bank right now because that's basically what America is telling you. You're safe with the big boys, not with the little guys. But anyway, yeah, Biden had a few quotes suggesting, "I'm firmly committed to accountability for those responsible for this mess. And no one is above the law, and strengthening accountability is an important deterrent to prevent mismanagement in the future. Congress must act to impose tougher penalties for senior bank executives whose mismanagement contributed to these institutions failing." Well, what he's basically talking about is why could somebody who helped lead to the bankruptcy of Lehman Brothers end up working at Silicon Valley Bank and basically needing a bailout after having failed 15 years ago? Why are they still in this industry? He's not wrong. Nothing's going to change, though. It's just the way the game is played. It's ridiculous. It's kind of like you see startup founders fail, and then they still raise hundreds of millions of dollars for random startups that are terrible ideas, not to mention any names. We work in flow. But anyway, when banks fail due to mismanagement and excessive risk-taking, it should be easier for regulators to claw back compensation from executives, impose civil penalties, and ban executives from working in the banking industry again. So says Biden. That's fantastic, but it's going to take some work from Congress to actually do something like that. Anyway, of the over $300 billion of emergency funding that has now flown from the Federal Reserve to banks, it looks like about $240 billion of that ended up flowing through the San Francisco division of the Federal Reserve. $55 billion going through New York. That $55 billion is probably all a Signature Bank. The 240 is probably First Republic. We're thinking First Republic at about 109 billion, and then the rest to Silicon Valley Bank, so somewhere around 88 billion likely to Silicon Valley Bank. So that gives you a little bit of insight into what's going on with Credit Suisse, bail-ins. Remember, folks, the coupon link down below for the amazing programs on building your wealth, the perspective that you get from me. You get it basically my brain on a platter on real estate, stocks, entrepreneurship, hustling, whatever. Link down below. I think all of them are individually fantastic courses, so see what works for you. And there you have it. All right, now we got to get to the next topic. All right. So next up, oh, this is going to be interesting. All right. So happy Saturday, by the way. Hex Flex is in the chat talking about an aircraft. Did you see the my post with the Hex sticker on the bank, on Silicon Valley Bank? That was awesome. Jeff here says, we're all going down. No bailout. All right, folks. Let's go jump into the next one, which is we're going to talk about, this is a really fun one. We're going to talk about the shadow tightening that's going on. This is an interesting one. All right. So let me pull up the Goldman Sachs Financial Conditions Index really quick, and then we'll also, let's get the break evens. Appreciate the support and the comments. I love that y'all are here. I wanted to stream a little later today. I'm just sort of testing out where people watch on the weekend. I might try early tomorrow again, just to sort of compare. I'm not sure though. Usually I like to stream 4:30 a.m. California time. Today we didn't start until 7, And I don't know how many people are actually around to watch that early on a weekend ordinarily. So I'm just testing things out a little bit. But anywho, let's grab a couple charts here. Wow. Okay. Okay. Oh, wow. That's going to be really interesting. I'll start with this. This is fascinating. Oh, wow. Okay. All right, here we go. This is going to be the shadow tightening part. So let's see here. All right. Well, folks, we got to talk about the shadow tightening that is happening by the Federal Reserve and how the Federal Reserve could actually lower interest rates while financial conditions are still so tight that we could potentially be pushed into a recession while the Federal Reserve is still cutting rates. That would pay homage to those individuals who say, see, Fed pivots when they break something and then things just get worse. Now, it still remains to be determined whether or not what the Federal Reserve is doing now is a pivot via the Buy the Fed Pivot facility, the $300 billion they basically just printed. Is that a pivot or is it a U-turn? Because generally pivots are bad, U-turns are good. Well, we'll probably know on the 22nd when we hear from Jerome Powell. But for now, we got to study the potentially dangerous implications of shadow tightening and shadow Federal Reserve policy. That's what we're going to talk about in this video. Now, two things that you have to know before we go into these pieces from Barclays. Number one is you have to understand what this chart is. This is a chart known as the Financial Conditions Index. It is a chart that is put together by Goldman Sachs. And because it's an index, it means it has different components in it. One of the components is stock prices. One of them is bond prices. Then you have lending tightness and other variables that basically combined tell you how tight are financial conditions in America right now. And it's very useful because it gives us a heads up on what is the Fed potentially likely to do on the 22nd of March or going forward. See, the Federal Reserve loves looking at this chart. Because when this chart goes down, like it did over here in January, and the financial conditions start going down while inflation is not falling as fast as it should, what does the Federal Reserve do? They come out and hawk. They start talking about how, hey, we need to tighten more. Now, sometimes the market does this themselves. Sometimes it's driven by the Fed's commentary. When we had Jackson Hole, we saw a massive burst of Goldman Sachs Financial Conditions Index, or the index here. And that's because Jackson Hole was really a time where Jerome Powell ended up coming up and saying, hey, financial conditions are too weak. We've got a lot of work left to do on inflation, and so we're going to have to hike higher for longer. And guess where on this chart, where do you think Jackson Hole was where Jerome Powell basically told us we got to do more? Where do you think it is? It was August 26th, which is basically right there. So you could see how either Jerome Powell can verbally tighten financial conditions with what he says, or the markets can tighten financial conditions. When we got the January jobs report, retail sales report, and all the reports that were really hot for January, look what happened. Financial conditions went from here straight up. This is what the Federal Reserve is trying to manipulate. Because the higher this chart is, the lower inflation expectations go. This is the inflation's expectations chart. And look at what's happened over the last few days as financial conditions have remained tight and as banks have started to fail. Look right behind me there. Look at that. Massive plummet, hugely plummet in break-even inflation rates. This is the 5-year break-even chart, which is fascinating because this is exactly what the Fed wants. The Fed wants this chart going down, and in addition to this chart going down, what do they want? They want this chart staying elevated. As long as those two things are true, they could actually reduce interest rates. And that's interestingly, interest rates, what we're going to talk about in these pieces. Now, these pieces are phenomenal. Two really good Barclays pieces here on shadow tightening. I'm going to go through both of them because they're really, really important. And you've got to understand these shadow tightening aspects if you care about the Fed at all, which I think most of you do. And if most of you care about the Fed, then you'll love the programs on Building Your Wealth link down below with the coupon expiring after JPOW talks next week at 22nd. So check that out. Link down below. March 22nd expiry. Awesome perspective and lifetime access, guaranteed to get the best price. So you buy today, you're guaranteed the price will never be lower in the future. Otherwise, you email and get an adjustment, although generally the price just trends up. It's because we keep adding value to it. Anyway, and anybody who buys keeps getting that lifetime access to value. So what do we have here? Rate investors are worried that credit will be curtailed, which could be a drag on growth with disinflationary impetuses. Okay. So let me actually, you know what? Let's go ahead and start with this shadow inventory piece because the other one gives us a little, is sort of more additional commentary. Let's start with this one. This one explains a little bit better. So this is the risk of shadow tightening. And they start with this commentary. They talk about how crazy the market has shifted. They say 1 week ago, following hawkish commentary by Powell, a 50 basis point hike was basically seen as a foregone conclusion, a done deal, along with much higher terminal rates. I mean, we were talking about going to 6%. Now, all of a sudden, all of that has U-turned. And hedge funds and systemic strategies were short bonds, and they got effed over the last 2 weeks, like really badly. They were super unprepared for what ended up being one of the biggest and quickest bond rallies on record. Bond prices up as people flee to safety, bond yields down. Remember when we saw bond yields crash from 4.5% on the 2-year to like 3.8? It was insane. I mean, we were watching some of this live. It was just insane how quickly some of these yields were falling. The 10-year went from like 4.1% to 3.4. That's like an 80 BP plummet. It's insane. Massive changes, right? So huge volatility. So what do we have over here? While all of this volatility was happening, and I thought this was actually a fantastic point for the stock market, they say here, looking at sector flows, they say that falling markets rarely bring good returns for equity investors. However, because equity investors have such low risk exposure right now, which is a fancy way of saying so many people right now are so heavily exposed to cash and bonds and not the stock market, you actually didn't see that much pain in the stock market. And I wrote good point on this because really, if we look at some of our stocks, this last week should have been absolute hell with this banking disaster. And look at QQQ, the technology index. What the hell? It's like on the average candlesticks up the last 4 trading days. Yeah, look at that. We're totally holding Fibonacci support. We're holding 200-day moving average support. Because why? Well, because people are so bearishly invested. You could literally have 5 bank failures in a week and you still hold support on the NASDAQ. Why? Well, because A, potentially QE, but B, because people are so bearishly positioned. But now they talk about a new set of systemic risk concerns being introduced. Banks will no longer be looked at as the pure and simple beneficiaries of rising yields and potentially the only winners of sticky inflation. Instead, they could basically be failing. And you could see the banking sector continue to trade down. But what's more important than just worrying about the banks? Well, the potential for this shadow tightening. And before they go into this idea of shadow tightening, they just quickly give you this sum up here to say, hey, look, central banks right now are very concerned about the contagion that could occur from these banks, right, and potential bank failures. And the first thing they tell us is right here. This is where we get into shadow tightening. One corollary of the volatility in banks is that lenders may tighten lending standards even further in order to protect themselves. This would act as a de facto tightening of policy, helping slow the economy and raising the likelihood of a recession. So think about that for a moment. As fears are established of banks failing, and people are positioned pretty bearishly already, what you have is people pulling on their purse strings more. That is a form of tightening. Yeah, we don't want to be in stocks anyway. Again, if people were in stocks, heavily in stocks, there's no way in hell over the last 2 weeks, the NASDAQ should not have broken these supports. But it didn't, because people are so bearishly positioned right now. The people who are in stocks are like, give me more. Come on. I need another buy the dip opportunity. So, which is fantastic. I mean, I increased my exposure to Enphase like 3 times this last week. It's almost at my load the truck price target, by the way. When this sucker was 300, and you know this, when this sucker was $330, I'm like, way overpriced. This sucker's going down. It could go as low as $160. It was like 180 yesterday. I'm like, yes, we're getting closer. Great company. It's just a bad time for them. But anyway, so people pull on the purse strings of their cash, but it's not just them. It's also banks who potentially tighten lending standards. And now that's actually interesting because remember, Silicon Valley Bank gave a lot of loans to startups with loose terms. Well, that made it easy for them to hire people and spend money. Well, that's fantastic, but it's also inflationary. Well, that bank has now failed. So who picks up? Well, maybe the big banks, but the big banks have substantially tighter lending requirements, and they're likely to tighten their lending standards, meaning less inflationary impetus, instead, more deflationary impetus. Take a look at this. Here's a piece that Zero Hedge tweeted out. They wrote, banking crises are followed by tighter lending standards. Duh. Tightening lending standards for small businesses versus the Fed discount window usage. Okay, so simple. Blue line goes up means banking pain. Dark blue line. Dark blue go up, more banking pain. Light blue line go up, more tightening of the economy. What do we have? Well, you have that tightening of 2008. You have the tightening of 2020. And now you're starting to see that tighten here. But notice how quickly that discount window usage has run up. It's possible that these lending standards will tighten substantially soon. This, by the way, is guess what practically happens in a shadow tightening environment. You've heard me say this before during financial crises, but if you have a HELOC, a lock, like a margin line, something that you want to preserve capital to, all of these could end up getting frozen. When we go into these sorts of banking crises environments, credit lines can tend to get frozen. And so what do sophisticated investors tend to do in these sorts of environments? They take them out and leave them in cash. You have to be careful, especially with margin. This is the one that I would be very, very cautious of. But what people often do is they say, look, I'm going to prepare by taking out as much cash as possible. So everywhere I could take out cash, I'm going to take out cash and I'll leave it in cash. Even on margin lines, sometimes people will take out cash and they leave it in cash. The cool thing is when you have margin taken out in the form of cash, you have that backstop, right? So it actually reduces your risk of getting margin called. With a HELOC or line of credit, there's generally no margin call. I really recommend staying away from margin debt, but some people will take the risk. I just caution, leave it in cash because you want to be able to survive potentially the really bad times, right? So what a lot of people do is when lending standards tighten is they take out their home equity lines of credit. They park them in a different bank. So think about this way. If you have a home equity line of credit at Chase, you take the money out of Chase and you put it into like Bank of America. So that way you have the cash and Chase can't like pay off their credit line. So you might not necessarily have to do that. You could potentially just move that into a different bank account at Chase. But if that credit line gets shut down, if you already have the money out, they'll just keep charging you interest. That's okay. They're not going to call your loan due and payable on generally a home equity line of credit. Read, obviously, your loan terms. On a margin line, they could call the cash back. But consider that a tightening lending environment could be occurring, and there could be some real practical implications to you. But in addition to this, when you see a tighter or sort of de facto tightening environment, you could potentially actually see the Federal Reserve cut rates. This is why you're seeing central banks start lowering rate expectations. In fact, they say here, we find that they say that, so repricing lower in central bank rates expectations is understandable, but Barclays thinks it's too aggressive at this point. In other words, this idea that the Fed is going to cut rates 100 basis points by the end of the year, they think is too extreme because they actually think a lot of these fears are overblown, but it is likely that banking financial standards are going to tighten. So they say, hey, look, we're looking at classic indicators of mainstream bank stress like TED spreads or FRA, OIS, overnight interest rate swap spreads. We're looking at these and we're not seeing any kind of massive systemic failure red flags, much like what we've seen in past episodes. Now, who knows? Everybody always says, oh, don't see it yet, don't see it yet. And then everything sort of blows up in your face, right? But the point is, lending standards could tighten significantly, basically doing the Federal Reserve's job for them. When the Federal Reserve has tight lending conditions, the Fed could cut rates and we could still walk into a depressive environment. And that's because people just don't have access to credit anymore. Remember, American Express is saying people are using their credit cards to basically spend through the recession. Great. But what if those credit lines get limited and they can't spend through the recession anymore? Oopsie doopsies. It's going to be really interesting. But keep in mind the shadow tightening that's happening. It could actually lead to an equity rally, in my opinion, much in the shape of, now there is a bear side as well. So I'm not always giving you a bull side here, but for the purposes of Barclays' opinion, I think what they're describing is very consistent with this form of a Nike swoosh style recovery. Extremely quick down, super volatile and extended long-term up. That's my take. That's why I think equities continue to trend up, because there's so much bearish positioning right now already. Is it possible the bear story could take over where we have a multi-year long depression? Yes. And we're going to cover that in a different segment because this segment's gone on for too long. But pay attention to the Goldman Sachs Financial Conditions Index. As long as that level stays high, the Fed is likely to be willing to lower rates or give us a lower path forward. Consider that. The dot plot of the Federal Reserve comes out on the 22nd. Now, that's actually fascinating because the dot plot could end up coming in soft. Look at this. Barclays in their second piece says here, we would expect the Federal Reserve to downplay their dot plot, citing heightened uncertainty about the path of monetary policy. And investors want to gauge how the Fed is going to balance financial stability and ultimately the risks of inflation. This is why they suggest, hey, look, we know the market is pricing in a lower term rate, but this could really create a credit crunch, which ultimately becomes a big drag on disinflation, right? Or creates a drag on inflation, I should say. It creates disinflationary impulses. And in other words, this shadow tightening really just amplifies what the rate is of the Federal Reserve. So the Federal Reserve rate could be 4%, but with shadow tightening, it could feel like 8%. And this is fascinating. So do consider that. They mentioned Barclays ends up writing this bottom line suggesting shadow tightening policy is likely being seen by investors as likely the equivalent of a few 25 bips of hikes in the future. I actually feel like it's more. I think if we're at maybe 4%, shadow tightening could make it feel like 8%. But that's going to be something of high debate. So we'll pay attention to that. And there is also the Great Depression scenario out of all of this tightening, which we'll talk about in another segment. But I think the bottom line for this segment here is the Federal Reserve could actually reduce rates going forward, and we could still see a down drag in markets driven by lower earnings because of the lack of available borrowing. So how do you position yourself for that? Bottom line for you is twofold. Number one, consider what this means for your credit lines. Does it make sense to draw down on your credit lines now before lending standards tighten and your credit lines get frozen? Number two, if you are investing, you probably want to be investing in what I call inflation resilient stocks. So you want to be looking for companies where people are still going to spend money even if they don't have easy access to debt. In other words, where's that wealthier segment that might continue to spend through this recession? Where are they spending money? Is it going to be businesses spending on artificial intelligence? Is it going to be consumers who have a lot of money maybe left over who still want to invest in energy or electric vehicles, solar panels, or cars for their homes? I don't know. Usually, when the housing market slows down, the first thing people do is they stop investing in their homes, which is bad for the solar industry, something we've been talking about for about a year. So consider that. If you are investing in stocks, I think the big thing is look for the recession resilient ones. That's my take, things with pricing power. Consider that credit lines could be getting frozen, and you might want to start putting away some cash from those credit lines. Yeah, you'll be paying interest in the meantime, but it's a consideration. And realize that even when the Fed begins to cut rates, it doesn't necessarily mean we're going straight up to the moon for the stock market. That volatility will still be here, especially as we wait for what this loosening ends up meaning for the financial crisis, the actual recessionary impulse for earnings at companies, and then, of course, the actual ability of individual companies to survive the pain. My take on shadow typing. All right, next. Let's see here. All right, so next up, let's do a couple quick political segments, and then I want to talk about the Great Depression scenario. See, that's good. Garrett, I actually appreciate that insight. Thank you for saying that. So let me just read this out. I sell solar, and we're having record numbers every month. I think you're wrong here. I'm selling more than I ever have in my life, so many homeowners are going solar. So solar is very interesting because, and this is why I'm not betting against it. I'm just cautious. For example, I still have an end-phase position that I'm actually building up. And so there are two sides of this coin. Coin number one is people spend less on their homes when values go down. Okay. Does that mean solar? Well, it probably almost certainly means Home Depot and Lowe's would have lower earnings because people might be doing fewer discretionary style remodels, right? But in addition to that, you also have this potential idea that if you buy solar, you might save money on your electricity bills. And maybe that is the right thing to do in a recessionary environment because you're investing and lowering your monthly overhead. So solar is this really interesting space where I actually think while you have this down pressure of people wanting to invest in their homes less, you also have this up pressure of people going, well, if we're in a recession, we want to save money, so let's buy solar. So you have this really weird balancing act, which makes solar very unique. And we have not been through a recession before, other than COVID, which doesn't count, where people have had to make that analysis like, well, if this is longer term pain, maybe we want to lower our electricity costs and buy solar. And maybe we don't remodel the bathroom. And so that's something where I think what you're saying is actually a very fair point and potentially real scenario that people might forego on the kitchen remodel, people might forego on the bathroom remodel or forego on whatever, a remodel in their home, new flooring or whatever, and end up buying solar panels. Now, I would like to sort of just give a quick recommendation on solar, my opinion. Y'all know I'm a licensed financial advisor, but this is not personalized advice. I don't know what your situation is, right? So you always have to evaluate ultimately these decisions yourself. But my opinion is that if you're going to get solar panels, you should buy them. I think power purchase agreements and leases are very risky because they limit your liquidity in selling your property. And so that's not good. Selling a property with solar is very difficult because you're relying on somebody else to want to take over that contract. And a lot of people don't understand that liability they're signing up for. So I'd rather see owned solar panels. So I personally have solar panels on my property. I've got as many as I could possibly have on here. I have an Enphase battery as well. I've got the Enphase microinverters. Big fan. Saves me a lot of money. Was a fantastic investment. Somebody else here writes with a $5 donation. Don't forget, solar is big in the prepper community. I have it for that. You have it for prepping, but living in Southwest Florida, there are savings and immediate ROI. Nice. Well, yeah, there's your World War III argument as well. How about financing them? Yes, that's okay. That's buying, right? So financing is buying. That's the equivalent of buying. And so I'm okay with that. You want to buy for the panels cash, pay for them with a credit line, pay for them with financing, with your company or whatever. Totally fine with me. It's the leases and PPAs that I generally caution people about. So fair game there. Exactly. If you buy solars, you have your own power, grid goes down. So you have to be careful about the idea about having your own power if the grid goes down. The idea here is you need to have the Enphase IQ8 microinverters, which I don't even have. And so most solar panels actually won't work if the grid goes down. They need to be connected to the grid to actually get it working. It's just kind of annoying. But the IQ8s will work with sunlight only. Exactly. So, okay, that's a good little append there on solar. So but it's one of the reasons I'm also so bullish on Enphase. But anyway, or get a Generac whole home. Generac's a good one too. I like Generac. Yes, Enphase is set up to work off the grid through the new IQ8s, not the old microinverters. All right. Next up. You know this guy's a prepper here. If the grid goes down and you have your lights on, you are my #1 target. The prepper community's making strategic bets. All right, man, who's got the power? Let's go raid them. Let's get our guns and raid them. That's awesome. Like in the negative sense of the word awesome. All right. Let's talk about Putin, and then let's talk not the Canadian food. And then Trump, and then we're going to talk about the depression scenario. All right, ready for this? All right, here we go. Should upcoming travel plans be canceled? Why? All right. Well, it's happened. The International Criminal Court, the ICC, has issued an arrest warrant against Russian President Vladimir Putin, along with other officials at the Kremlin over war crimes in Ukraine, quote unquote, alleged war crimes in Ukraine. The arrest warrants were issued based on evidence presented by the ICC prosecutor, which provided reasonable grounds to believe that the suspects, Putin, are responsible for war crimes and crimes against humanity in the context of the invasion of Ukraine. An example of this would be potentially and intentionally maybe aiming weapons and ICBMs, intercontinental ballistic missiles, at apartment buildings to essentially engage in total war. Total war is very importantly different from just regular war. Regular war, think about it kind of like Revolutionary Day times, like 1776. You know, you're walking up with your drums and you're lining up in the battlefield and you're fighting. That's sort of like battlefield warfare. Same thing happens to some degree in parts of the Middle East. When that expands to an attacker attacking a city and then purposefully killing civilians and attacking apartment buildings or schools, that is considered total warfare. That's basically saying everybody on the other side is against us. We will attack everyone. That is being deemed a war crime. In a report by CBS, they quote the ICC saying the evidence collected so far is clear. The Russian Federation is responsible for the commission of heinous crimes, including murder, torture, and attacks against civilians. Now, we've also got to cover what's going on with Russia and China in terms of the latest regarding Ukraine, jets, China. We'll cover all of that. But let's first just cover the ICC and then move on from there. So the Associated Press has also been looking into the use of prohibited weapons in civilian areas, which would be another war crime. However, it's also worth noting that the issuance of these arrest warrants really raises question about the impacts of this. Some people are suggesting that these ICC warrants are A, going to be entirely worthless, and B, potentially put a new spin on Xi Jinping visiting Russia. Because remember, Xi Jinping was going to go to China, was going to go from China to Russia to try to potentially negotiate a settlement between Russia and Ukraine. Well, now these ICC charges potentially implicate Xi Jinping if he goes to Russia to visit with Vladimir Putin, and Vladimir Putin's facing charges, and Xi Jinping goes over there and visits them, sort of ignoring these potential charges. And so there's a wonder that, is it possible that these ICC charges could inflame negotiation attempts that Xi Jinping is trying to create between Russia and Ukraine? The Wall Street Journal is citing that this is the first time a sitting head of state has been subject to an arrest warrant from the ICC. On Twitter, there have been plenty of responses asking why George Bush, for his Operation Iraqi Freedom, hasn't faced ICC charges. But then again, Twitter can tend to be very jaded, dare I say. There are also reports that the Russian government has of course, denounced these. And the quote that is being reported is absolutely absurd and groundless. There's evidence from the BCC that part of the motivation for these ICC charges are simply the scale of civilian casualties and the destruction of civilian infrastructure, such as purposefully launching rockets against electricity grids, nuclear power generators to purposefully take control over the power grid in Ukraine. Reuters is explaining the ICC relies on the cooperation of member states to enforce these arrest warrants. It does not have its own police force. So in other words, like a NATO or whatever would have to arrest Vladimir Putin, which, yeah, that wouldn't knock on the door of World War III at all. The warrants have been transmitted to relevant state authorities under the Rome Statute to locate, arrest, and transfer the suspects to the ICC for charges. So here's how this works, a little bit of background. When the ICC issues an arrest warrant, it represents a formal request to authorities throughout the world to arrest the individual subject or suspected of committing serious crimes and bring them to the International Community Court, or the ICC, International Criminal Court, to face charges. So in other words, find him, arrest him, and bring him to court. In such cases as when the warrant remains outstanding, the ICC continues to seek cooperation from all the member states to bring the person to justice. And basically, there's like a 6-part process for this. Identify the suspects, issue the warrant, that's been done, work with member states to locate, arrest, and transfer, execute the warrant, actually arrest the person. Before the trial, confirm the charges against the person, redetermine, do we still have sufficient evidence? Has anything changed? Then commit or basically conduct a trial. So once the charges are confirmed, the case would basically proceed in the manner of a trial before a trial chamber, the ICC trial chamber. The prosecution would then present evidence, call on witnesses, and make their arguments much like a regular court. This trial chamber from the ICC could then impose a sentence, including imprisonment or massive financial penalties. Now, the ICC Criminal Court, I feel like it would be a lot cooler if it was one of those things out of like a Marvel movie. The ICC Criminal Court doesn't actually look that fancy. It's basically a pretty generic tribunal with a desk and some kind of like generic wall. We have a picture of it here. That resolution is too small. I'll pull up a large resolution photo of this in just a moment. But really, it's interesting because it's the first time, as we've said, that a head of state who's actively a head of state right now, has been charged while still being the leader of a country. So we'll see what happens, but I do think the implications for China here are very interesting. This is what the tribunal looks like. Looks kind of cold. I feel like they need to have like some kind of like crazy marble staircase and massive marble monument back there to make it a little bit more intimidating. But anyway, this is the ICC, and this is going to lead to a lot of questions for what does this mean for China's potential negotiations with not only Vladimir Putin, but also Zelensky. It kind of makes me wonder. I put on a little bit of the jaded hat. I kind of wonder, and this is total speculation, okay? But total speculation, okay? Joe Biden. Hey, ICC. I hear Xi Jinping is coming over to negotiate a resolution. We don't want him to negotiate a resolution. File some charges. Make it harder for Xi Jinping to go over there. All right, thank you. Bye. And then it happened. Like, I hate to say I'm a little jaded on that. Okay, my take. But this gives you some of the latest on what's going on with the Putin arrest. Now, we got to talk about another one. This is crazy. We got to talk about the Trump arrest. Listen to this. It's being talked about right now.
Being able to be proven and based on an old and fully debunked by numerous other prosecutors fairy tale, the far and away leading Republican candidate and former president of the United States of America will be arrested on Tuesday of next week. Protest. Take our nation back. Now, this case centers around a $130,000 hush money payment to adult film actress Stormy Daniels on the eve of the 2016 presidential election. President Trump's former lawyer, Michael Cohen, you see in the middle there, pleaded guilty to his role in that payment in 2018. He claims it was meant to keep Daniels quiet about an alleged affair that Trump denies. Federal prosecutors have claimed the former president and his business reimbursed Cohen for that payment. Now, of course, Trump is a leading contender in the presidential race, the front runner in the Republican primary. He claims this is yet another politically motivated attack to prevent him from running in 2024. Listen here.
Whether it's the Mar-a-Lago raid or the Unselect Committee hoax, the perfect Georgia phone call, it was absolutely perfect, or the Stormy Horseface Daniels extortion plot. They're all sick, and it's fake news.
So, Neil, regarding Tuesday's potential arrest and the expected indictment, Trump could be charged with falsifying business records for reimbursing Cohen under the guise of legal expenses. But to make that crime a felony, Manhattan DA Alvin Bragg's prosecutors will have to prove that Trump did that to conceal another crime, which in this case may be an improper donation to his 2016 campaign in violation of state election law. Fox News reached out to the Manhattan DA's office for comment, something they declined. We do know the DA's office reached out to law enforcement about security plans surrounding the courthouse this week. We'll send it back to you, Neil.
All right, Nate. Thank you for all of that, Nate.
Yeah, so here's some extra detail on what's going on here. First of all, you could actually look on YouTube. You type it into YouTube, Meet Kevin, Donald Trump, Georgia phone call. I cover the entire phone call. That phone call, and I'm not taking sides here, I'm just saying as neutral as possible, was not a good phone call. It was not a good look. It was not a perfect phone call. It was bad. It was basically Trump going, come on, man. What can we do to find 12,000 votes? It's not good. That's not perfect. Okay, anyway, so let me give you some detail about what's going on here. So basically, here's what's going on. While Donald Trump has not been arrested yet, he's now confirming that, yes, he is expected to be arrested on March 22nd in connection with this Manhattan probe. And it's really sparking concerns that we're going to see massive, potentially MAGA protests on Tuesday, much in a similar manner of maybe a Jan 6, except this time it'll be March 22nd, which is also the day the Federal Reserve comes out and tells us whether we're going to oblivion or not. So let's just put it this way. March 22nd is going to be a very interesting day. Not only is it the day that my coupon code for the programs on Building Your Wealth with amazing lifetime access to my course member live streams and everything else that's in them, the added value you keep getting, the price guarantees you get for getting the lowest price possible with this coupon going forward, that expires on that day. But you might have a new Jan 6 and Jerome Powell crashed the economy all in the same day. So if you're looking for entertainment, I'll be live probably all day long on the 22nd. I am canceling any travel plans. I will be right here on the 22nd because I can guarantee one thing. It is going to be entertaining as hell. Now, let's discuss some of the insight into this. So this arrest is believed to be related to, well, it is related to the Manhattan District Attorney's investigation into these hush money payments that were made to Stormy Daniels in 2016. The hush money in question is basically $130,000, which Trump's former lawyer, Michael Cohen, had admitted to paying Daniels, potentially to keep her quiet about an alleged affair with Trump. Now, Donald Trump has denied the affair and accuses Daniels of extortion. In 2018, Mr. Cohen was charged in connection with these payments to Daniels, but Trump did not face charges for his election or his involvement in 2018. The reason for the delay in pursuing Donald Trump at this point potentially has to do with the tax fraud investigation for Donald Trump. This is where Donald Trump faced about $1.6 million in penalties because of the result of a tax fraud investigation involving the Trump Organization. Now that that tax fraud investigation is complete in New York, the New York Department of Justice and prosecutors essentially are arguing they have enough resources now to investigate this current case, this hush money case, because the tax case is closed. So it's kind of like they're doing one case at a time rather than working on them at the same time. Now, remember, in 2018, Michael Cohen pleaded guilty, stating that he worked in coordination with Trump to silence Daniels. Although the Justice Department bars federal prosecutors from charging a sitting president with a crime, since Donald Trump hasn't been pursued while he was in office and is now being pursued. This is basically a skeleton that's popping up to haunt him now. Obviously, you saw Donald Trump's response to this as well. I mean, I don't need to reiterate some of the comments he made about Stormy Daniels. But anyway, Trump has also criticized Michael Cohen, which is sort of a way of him separating himself from Cohen, and ultimately describes the cases against him as a weaponization of the judicial system to try to prevent Donald Trump from running for president in 2024. Now, which he's already announced. Now, Manhattan District Attorney General Alvin Bragg is the guy leading this investigation. He has a history of focusing on cases obviously involving criminal justice reform, but also civil rights. And it all started with his idea, and this is very questionable, but it started with his day one memo, where he outlined a list of crimes that they will not prosecute in New York, such as marijuana possession, fare evasion, trespassing, and even prostitution. In other words, New York is willing to turn a blind eye if you just hop the subway fare turnstile because we don't want to keep punishing criminals. This sounds very similar to the kind of nonsense that's happening in San Francisco, where San Francisco is essentially the car break-in capital of the world, and law enforcement essentially do nothing. Even Elon Musk on Twitter questions, are the police even allowed to enforce the law in San Francisco? Anyway, the shift in focus from Trump's alleged practice of overvaluing assets for his real estate properties to prop up his net worth, to prop up his ability to get financing or win deals, has led to massive investigations in New York. But that shift is now moving over to this hush money issue and potential campaign donation issues. The tax fraud case, which again recently concluded, had to do with a 15-year potential scheme of avoiding paying taxes on the valuations of certain properties, but potentially also had to do with employee benefits, like giving employees fancy cars, apartments, or paying for their schools, and then not having the employees pay income taxes on those. So those are deemed to be. There are a lot of things at play here, right? There's the hush money payment. There's the overvaluing of assets. Then there's the potentially overpaying employees without paying income taxes on those. There's a lot of this. This is the next phase in all of this. And the trials end in that tax fraud case really now is allowing this potential indictment, which is looming for March 22nd. And you saw Donald Trump himself now saying he's talking about, yep, going to be arrested on March 22nd. At the same time now, the Secret Service and FBI are already conducting security sweeps in anticipation of what is expected to be a pretty dramatic Tuesday. That is March the 22nd. Let me make sure. March 22nd, 2023. Is that Wednesday or Tuesday? That's Wednesday. Sorry. To Wednesday. So Wednesday is the big day. But anyway, they're also trying to evaluate how are they going to arrest Donald Trump? Do they handcuff him? I mean, technically, to be arrested just means you're not free to leave, right? A detainment. You don't technically need to wear handcuffs, but politically, seeing Donald Trump in handcuffs would be a field day for Democrats. So you could bet Democrats are calling for the field day of handcuffs and the media spectacle. On the flip side, no handcuffs would potentially be seen as respectful to a former president, which, of course, people who don't like Donald Trump are like, he deserves no respect. But it's very interesting. What implications does this also have for our international community to see a former president in handcuffs? But anyway, if Trump is indicted, he would be required to go through the standard legal booking process. That means being processed. That means mugshot, fingerprints, processing. Then you get indicted, which it's important to know what an indictment actually is. An indictment is simply the presentation of charges. You stand before a judge, and a judge reads out, Donald Trump, blah, blah, blah. You are being indicted for the following alleged claims. Count 1, fraud. Count 2, this, that, and the other, tax, whatever it is, right? Those are the things that Donald Trump would be indicted under. Now, this does not actually mean that Donald Trump would end up being in jail. That's because Donald Trump could, via the discretion of the judge, be released on his own recognizance, ROR. And the idea of that is, hey, as basically you post bail, you'll get released, and you need to show up to court. So I've merged two things here. I'm skipping over some details here. ROR doesn't generally require a bail payment. Bail is you promising to come back to court. Both of these are a promise to come back to court. Sorry, I'm kind of glossing over that a little bit because I don't think that so terribly matters. The point is, Donald Trump probably will not be in jail because jail is where you go when you're being held for a court case. And jail is where you go after you are punished and your sentence is less than a year. Prison is where you go when your sentence is more than a year. Just to give you a little bit of a detail on that. But clearly, we would expect some form of massive political and protest fallout from this drama. Now, let's take a brief listen over here just to see what some of this commentary is.
Who had really just kind of put out the rumors. The former president trying to take the offense on this. Hey, it's going to happen. It's unfair. It's a witch hunt, but it's on for Tuesday. We'll see. In Lower Manhattan. All right. In the meantime, here the latest.
Yeah. Okay. They no more contents. In other words, basically, yes. The 22nd is when the charges are expected. He said Tuesday too. Is everybody messing up on the dates here, or is it going to be Tuesday? Are they moving it to the 21st? Now I'm very curious. Did I get the date right? So because I'm pretty sure they said the 22nd, but let's see here. Oh no, Tuesday. Okay. All right. Well, let me clarify that. Okay, well, that gives us two fantastic days here. So apparently it's the 21st for the Trump arrest. So I want to be very clear about that. The 21st for the Trump arrest, and then the next day is the Fed meeting on the 22nd. And that's also where that coupon expiration sits. Okay, thank goodness. Separate days. So it's going to be a very entertaining week. All right, we'll see what happens. All right, next up. Depression. Talk about the depression scenario. Oh, God, it's a lot on this one. Oh, dear Lordy. All right, I got to cover. That's one. Okay. Yeah, this is actually fascinating. This scenario we're gonna go through right now. Yep. It's just gonna take me a moment to pull up. Apologize for that. We gotta pull up greed and fear, nightmare scenario. We'll pull up the talk about boomers, commodities. Where's Steve when you need him? Boomers, commodities. And then we need to pull up the systemic risks. Disaster. I hate looking at the bear cases, but I will. All right. I always think it's funny when people like, they read the titles of the videos and they're like, one day Kevin's bullish, the next day he's bearish. And it's like you can always tell who only reads the titles because I'm covering the bull case and then I covered the bear case. What I'm doing is usually pretty obvious because I talk about it in both cases. Whatever, man. Suresh is going to fill in for Steve. Oh, yeah. Anyway. All right. Let's look at the nightmare scenario. Kevin's child voice is the worst. Hey, man. Sorry, I'm really enjoying this Kahlua. I mean, coffee. That's good. Where's my chaser? I mean, let's get into the video. All right. So, here we go. As always, folks, we got to cover the depression scenario, the Great Depression scenario of tightening financial conditions, the Fed potentially U-turning a massive Great Depression that will be worse than 2008. Michael Burry is calling for it. That this is no different from the crash of 2000, no different from the great financial crisis of 2008, except we are walking into the Great Depression. And in this video, we're going to cover institutional coverage on the not so benign Great Depression scenario that we could be facing. Now, many of you know that I am not the biggest bear today. I was a mega bear in January of 2022. That was the perfect time to start being a bear. Today, I am not a bear. However, I like to pay attention to what the bears are saying. And that is the coverage that we are going to go into right here. First, we are going to start with a Jeffries letter on greed and fear. And then we will cover multiple other institutional pieces on the depression scenario following banking crisis. Here we go. Jeffries says, check out the programs on Building Your Wealth link down below with an expiring coupon code on March 22nd. All right, we got that out of the way. So, the Silicon Valley Bank collapse is a hint of potentially massive financial problems building in the former boom areas of private equity and private lending. And unfortunately, the private equity market could lead to collapsing, could lead to a massive disinflationary impetus for our economy. And the impacts of that will be great. Let's analyze what some of those could look like. Take a look at this. The fact that the credit boom in the past cycle was in private lending or shadow financing will mean that lags in monetary policy will prove to be even greater than normal. This is to say that while in 2008 we had a boom in real estate, over the last decade we had a boom in private lending known as shadow financing, like startup lending. And the collapse of Silicon Valley Bank shows us the potential for a shoe to fall. But this does not mean there will be no impact from monetary tightening. Rather, in a world where the U.S. enters recession, Silicon Valley Bank will be seen as the first hint of problems to come in private equity. Just as the failure of New Century Financial in April of 2007 was the first hint of problems to come in subprime mortgages. They're comparing today to April 07, which means much more pain still ahead. In this respect, 2022 was the year where U.S. equities suffered multiple contraction from monetary tightening. 2023 will be the year of earnings downgrades hitting the stock market if the recession proves to be accurate, and we do go into recession, which we widely expect. This is now the key issue in financial markets. 2024 will be the year when markets will have to end up dealing with the emerging credit problems of the private equity space. In other words, multiple compression 22, earnings compression 23, private equity collapse by 2024. That calls for mega hell over the next 2 years. And it really makes you want to make sure you have your life insurance up to date. Go to metkevin.com/life. You could sign up for life insurance in as little as 5 minutes. It's the life insurance Lauren and I use. It's fantastic. 5 minutes on, and you can Apple or Android pay for it. It's great. In this respect, it's both amazing and an opportunity that the leveraged loans price index. Leveraged loans is usually lending for riskier companies. And there's an index that tracks pain in this region. And it's still only trading 6.2% below its recent high. The greed and fear index is basically recommending you short leveraged loans. You can Google how to do that. But basically, they're saying things about to hit the fan. They say this would be a good as time as any if the recession forecasts are accurate to jump into shorting leveraged loans and private equity and being prepared for the true pain that's coming, because they believe that we are heading into a 5-quarter long recession. Folks, 5 quarters is 1.25 years. In other words, if we go into a recession Q4 of 23, we could be in recession all throughout 2024. This is scary. They also believe that unfortunately, because inflation is remaining sticky, the Fed is going to be in a very, very tough situation. They call Jerome Powell a wannabe Volcker. They say his failed wannabe Volcker act has now put him in a pickle because inflation is not falling fast enough and we're in a financial crisis, which we were not in this sort of financial crisis the last time around. Now, maybe we'll get some clues on what happens on March 22nd in terms of what Jerome Powell ends up deciding to do. What does he forecast with the dot plot? But he is in a pickle. And what does this potential pickle mean for the bear case? What's the nightmare scenario? Well, here it is. T.S. Lombard tells us what the nightmare scenario potentially looks like. So first, they talk about how this cycle, I hate the phrase, is different. They talk about how this cycle is different because in this cycle, and many institutions have talked about this, this cycle is different because really what households are doing in this banking crisis is they're pulling deposits out of banks and they're buying treasuries. And that's actually really interesting because that's what we did with House Hack as well. That's my real estate startup. Now, it's important to know, by the way, that we are closing the funding round. We may never have another funding round until we IPO. For House Hack, we're closing that funding round on March 31st. Go to househack.com to read the solicitation there. This video is not a solicitation. While we are trying to do the non-accredited round at the same valuation, probably for May or June, we can't guarantee that'll actually happen because if the SEC doesn't give us a green light, we'll just start operating and we won't do a fundraise. So if you're accredited, you got 12 days left to potentially get in on House Hack. But anyway, what we did at House Hack is we pulled most of the money that we had and we bought treasury bonds back in November. So we've been milking like $70,000 a month of just cash of revenue from treasury bonds, thanks to having these treasury bonds instead of having them at banks. But that's actually part of the reason why you're having a banking crisis, is because money is going from bank accounts to treasuries. You actually didn't have that happen so much in prior recessions. In prior recessions, yeah, people sold stocks and spent less money, but they didn't flee into treasury bonds. But that's actually creating more banking stress this time around, which is quite interesting. On top of that, because the Federal Reserve is going through a quantitative tightening process, except for this last week where they expanded a little bit by $300 billion, just the ditto $300 billion, the Fed is actually destroying money. It's the opposite of the money printer. You're vacuuming it up and lighting it on fire. The Fed's balance sheet, if it were constant, then the money that's going into buying treasuries would actually flow back into the economy. But because we're quantitatively tightening, we're actually burning money. That burning of money leads to potentially more banking risk because banks are basically having to move cash to people's pockets and potentially move held to maturity securities to cash. That means taking even more losses at banks. T.S. Lombard here says banks can tend to be cheeky with what they do. Let me explain this cheekiness in a very basic way and why this banking crisis could get worse. In English, there are two places the Federal Reserve or banks can put their bags. AFS, available for sale securities, and HTMs, held to maturity securities. You don't really have to understand all of the differences between these, but in English, these are things that they're willing to sell. These are things they're not willing to sell. Let's say you bought Enphase at $80 and you bought Tesla at $300. Let's just say, okay? Well, you would be holding the bag on Tesla stock and you would be up on Enphase, right? So how could you be cheeky with your financials if you're a bank? Well, just say your Enphase stock is available for sale. And here, what do? You mark to market, which means you actually look at the current market value and you say, look, we have a profit. We're so smart. We have a profit. Just look at our gains. And then you hide your losses in available or held to maturity securities. And so you hide your bags over here where there is no mark to market requirement. So in other words, the banks can hide their bags legally hide their bags and not hide their bags on the available and basically prop up their available for sale securities, right? What does that mean here? Well, if more people are pulling cash out, banks are like, crap, this is going to expose our bags. In other words, when the bags get exposed, things could get even worse for the banking crisis. And so T.S. Lombard asked the question here, why would you keep your money in deposits unless the Fed cuts rates or banks raise rates? Right? It's a fair question. Why would you have your money sitting in cash if you could be milking 4 to 5% on treasuries? It doesn't make sense. And so in other words, the Federal Reserve may have to straight up cut their rates to prevent the banking crisis under what treasuries are yielding to stem the flow of the banking crisis. And until this happens, the financial crisis continues because financial conditions keep tightening. Here's the nightmare. The nightmare scenario would be the financial system cannot take any more tightening, but the real economy needs it. Inflation stays high, which forces Fed rates to stay high, which forces banks to expose their bags more, which leads to more banking collapses while rates are high and the Fed has to over-tighten. To stop this crisis, you have to lower rates and guarantee deposits. You have to quell the panic. Guaranteeing deposits is what the Fed has started to do with the Treasury Department, but not at all banks. The Treasury Secretary Janet Yellen basically just told you your deposits are not safe at small banks. In fact, I could show you that, which is very scary because think about it. I've regularly been saying that you should be cautious about having your money at the small banks. Now, some people are like, Cavett, you're creating FUD and you're going to create the bank run. No, I see a fire and I'm warning people that there's a fire coming to you. I feel like I'm not part of the problem. I'm identifying the problem, right? This is like, it's very obvious. If you have more than the FDIC insurance limits at the bank, at small banks, why would you be there? That doesn't make sense. And listen to what Janet Yellen tells you in her congressional testimony right here. She gives you the biggest warning that you possibly need to get out of small banks.
We're dealing with on it. Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is
And
your
we
plan?
made that determination.
Right. So
these
what is
two
your
banks.
plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen
Nothing.
the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No, it's
fail.
happening
And
because you're
it's-
fully insured no matter what the amount is. If you're in a big bank, you're not fully insured if you're in a community bank.
Well, you're not fully insured. And
You
the big-
were at Signature and
the
it
big-
just barely met that threshold. You were at Signature.
well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence in the system, and we took these actions.
So there's a
to
special
discourage
assessment that's been done
contagion.
on community banks in my state and all banks across the country. Was there any discussion that that special assessment would only apply to the larger banks, or was it always assumed the special assessment would cover every bank, including rural banks in my state?
I think I'm not certain what the rules are around that. That's for the FDIC.
Yeah. All right. So we got the message loud and clear, Janet Yellen. The big banks that are systemically important, plus or minus $250 billion, they get bailed out. Their depositors are safe. If you're at a small bank and you have less than the FDIC insurance limit, if you have not yet gone to the FDIC calculator, do that. Google it, FDIC calculator, and Google how protected you are. You should leave the small banks. That is what Janet Yellen is telling you. She is grabbing you by the shoulders and saying, yeah, we're not protecting all the small banks. They're going to go away. And it sucks. But there are going to be a lot of bankruptcies and a lot of unemployed people. And this banking crisis is not getting better. It's getting worse. And the question is, how bad is it going to get for the big boys? The small boys going away, that's already almost a foregone conclusion. The big depositors are probably going to flee the smaller banks. I hate to say it. It's terrible. But the crisis could get a lot worse because now the Federal Reserve is being called upon to not only to protect all depositors with the Treasury Department, but also stop quantitative tightening, because quantitative tightening is leading to more outflows from the banking sector, which is just making this issue worse. And the problem with this is the following. T.S. Lombard here says, this alone wouldn't solve the problem from a bank perspective, though, as people would still be putting their money into money market funds instead of leaving them on deposit. The crisis has revealed to anyone who has been asleep all last year that they can finally get a return on their liquid assets. So why would you leave your money in a bank right now? Banks could raise deposits, but that would represent a significant hit to profitability. That means there probably will end up being another required step from the Federal Reserve: cut rates, potentially quite aggressively. Banks will have to increase their deposit rates to stem outflows, damaging profitability. But we reckon the Fed will help them by cutting rates and bringing money market fund rates back down closer in line with deposit rates. Otherwise, the tightening of financial and credit conditions will be hard to manage. For the ECB, the financial system is less dynamic, but outflows to money market funds are a problem here as well. Central banks on both sides of the Atlantic will, in any case, be incentivized to wind back policy by deteriorating activity data and slowing inflation as the credit crunch unfolds. Big picture, we're in a multi-year-long slog back to higher yields. That's their take. By the way, I wrote a little note here. Bank assets being bought and sold are probably why so much volatility happened in bonds last week. The banks basically liquidating. But anyway, they do mention here, though, that because the assets in question, the treasury bonds we talked about, are also the assets people are buying, there is no doom loop yet. But where is the depressive doom loop? Where is the real depression? Listen to this. The credit crunch is already now going to expose fragilities in the economy, in the other areas, specifically commercial real estate and intra-Asian flows being the elephant in the room. These have a risk of a doom loop. So remember what a doom loop is. Let me first give you what a doom loop is not, okay? A doom loop is not sell treasuries, right? That's not a doom loop because when people sell treasuries, yields go up. And what are other people doing? They buy treasuries. Now, that does create some doom in the fact that it reduces deposits. That creates some doom for banks. But this is why I say in recessions, you stay away from financials. Said that for over a year. Okay. What is a doom loop? Well, here's what a doom loop is. Ready for this? Commercial, or I should just say real estate in general. Here's an example of a real estate doom loop. Okay. So real estate doom loop. Number one, less investment. What does that do? Lowers prices, lowers rents. This is this then lowers. This one here is kind of like lowering your multiples, and this lowers your cap rates. Both of these really bad because they funnel together. As prices go down, because people are less interested in investing in commercial real estate because they don't need an office. They don't need to expand their business because there's less available debt for them to borrow. Lending standards have tightened so much. What then happens? Prices for commercial real estate go down, multiple compression. Then what happens? Well, rents could also go down. But if rents go down, then prices should also come down for commercial real estate. That is a style of a doom loop. But not only that, what you could also see is a collapse of pricing in commercial mortgage-backed securities, CMBSs. Why? Because banks are having to liquidate their held-to-maturity securities, small banks having a disproportionately large number of commercial mortgage-backed securities. When I met with Kathy Wood for dinner, she made it very clear that it's the small banks that have the vast majority of the CMBSs. 25% of their book is CMBS, whereas the big banks, only 7% of their book is CMBS. If you want to learn more about this kind of stuff in perspective, how to think about this, remember, Programs on Building Your Wealth. The coupon best price expires on the 22nd. But anyway, when you get a collapse in these bonds, now all of a sudden you're killing the wealth of institutions who would ordinarily be buyers in the first place for office buildings or commercial buildings or for basically institutional real estate, right? That potentially creates a doom loop because now guess what happens? Now institutional real estate prices come under pressure, which makes those more attractive over residential real estate. Now investors stop caring about residential real estate because there are better deals in commercial real estate, maybe apartment buildings, for example. Residential real estate is usually considered 1 to 4, house, duplex, triplex, fourplex. Anything else is generally considered commercial real estate, 5 units plus, office, whatever, retail, you name it. So if it's more attractive to invest in commercial real estate, then you have less buyers in residential and potentially institutional liquidations in residential. So people keep saying that, oh, the real estate crisis is not a big deal because inventory is so low, homeowners aren't going to sell. Homeowners are just one piece of the pie of this whole crisis. One piece. That's it. Institutions go away. Now you have less demand for investment real estate, pushing up cap rates potentially for the commercial stuff, lowering them for residential, which drive or making residential prices look lower, or pushing. You're basically putting downward pressure on residential real estate to convince investors to go back to residential. And this creates a doom loop again, where prices potentially spiral down for real estate through not only tighter lending standards, but also just less investment. And that is just an example of what you could get in this sort of depressionary environment. T.S. Lombard here says asset prices are still clinging on to the old way of life, available debt, available credit. And really, this crisis that's beginning with Signature Valley Bank, Signature, Credit Suisse, these are not coincidences. These are most likely the start of us seeing the economy deteriorate. And we're now going to start uncovering behavioral changes that have not started reflecting yet in asset prices, specifically real estate. And we're weaning off the global financial system and an economy that's used to basically permanent, easy liquidity, cheap, easy debt. This is a big red flag. So this is why you're seeing these nasty scenarios, these potential nightmare scenarios. So it's not just them over here. It's also over here. The potential loss of confidence you could see. In the not so benign scenario, this is according to Barclays, there could be a loss of confidence and the credit contraction would likely be abrupt, throwing the U.S. economy into a hard landing in short order. While regulators have taken important steps to avoid these outcomes, such as by making depositors whole, an additional step could be to guarantee all deposits of the banking system. However, that would require Congress to act, which may be a possibility, but so far is unlikely. If there is indeed a crisis of confidence throwing the economy into a recession, history suggests the Federal Reserve will be forced to ease aggressively. In past recessions, the unemployment rate has risen by 3 percentage points on average. That would be going from like 3.5% to 7.5%. And the Fed cut more than 500 basis points when not constrained by the zero lower bound. Well, basically, that means if we go to 5% now, we could be going right back to zero. So in this sort of hard landing scenario, the left tail risk is increasing substantially, which is the recessionary risk, the cut risk, the rate cut risk. And in other words, we could be seeing a lot more pain ahead of us and a lot of Federal Reserve cuts at the same time as we see more pain. Now, one thing that slightly props this up a little bit is this idea that boomers are more in cash. However, boomers are also potentially likely to create inflation. This piece by Lombard suggests that basically there are compositional effects of people's life cycle. And they basically tell you this. Young people aged 5 to 29 and old people 65 and plus are inflationary. The people in between who actually work are deflationary. So people working are deflationary. People spending money and not working are inflationary. But we're potentially, and they're saying that this era right here is why we had a great moderation in inflation. Well, now the people during the great moderation of inflation are becoming older, and that's very inflationary. So now you have to put together the piece of the puzzle that you're getting here. You're getting a potential, one, end of the great moderation of low inflation. That's an argument led by potentially boomers retiring, which is inflationary. Okay, so now you have more sticky inflation. More sticky inflation equals Fed forced to keep rates higher for longer. However, now you have a banking crisis and doom loop for real estate. I didn't even mention it earlier, but a doom loop for real estate is generally considered bad because we know that Mr. Shiller, who put together the Case-Shiller Index from Princeton, famous Princeton economist, tells us that when real estate prices go down, people spend less money. All of that is depressionary. Depressionary. There we go. Apparently that's not a word. But anyway, that could lead the Fed to cut basically to zero. We could go right back to zero in this sort of depressionary scenario. However, that might not be enough to prevent pain throughout 2023 and 2024. Remember the crisis we talked about earlier in the segment. 2022, stock prices down. 2023, earnings down. 2024, private equity and lending down. And this would be the start of tightening lending. So in other words, if you want a really bearish case, this is it. Everything sucks going forward to 2024. Now, my take in this is maybe, it could be wrong, but maybe, just maybe, is it possible that inflation does end up proving to be transitory? That's the only hope you can have. is that the inflation, here's your great moderation, then you get the COVID inflation, and this is kind of where we are now. Is it possible that this inflation we've seen right here, this disinflation continues? If that disinflation continues, then maybe, just maybe, the Federal Reserve could cut to zero, prevent the depressionary, like the full depression, and put a floor under the real estate disaster and a floor under the banking crisis. Basically, it is now high time that disinflation occurs on hyperspeed. So, here's your take. If you think inflation will prove transitory, now may be a great time to invest in stocks. Hashtag not personalized financial advice. I have no idea what the hell is going on in your life. Yes, I'm a financial advisor. Yes, I have amazing programs on building your wealth. Link down below, especially 0 to millionaire real estate. A lot of people are bundling that with stocks and psych right now. Big coupon expiration coming on March 22nd. So anyway, if you think inflation is transitory, now could be the opportunity of a lifetime to invest. And I personally think you go for pricing power style stocks in that environment. Something that would be somewhat recession resilient for a short, shallow recession. Because that way rich people can basically keep those stocks propped up. Rich people and rich businesses can keep those propped up. Think NVIDIA, Taiwan Semiconductors, AMD, Tesla, Enphase, stuff like that. Enphase is on sale right now, by the way. I think great opportunity. We're getting close. 160 is like my load the truck target for Enphase. But anyway, if you think inflation is here to stay and the great moderation is over because of like this boomer talk, or the stickiness of inflation. And I really summed up this boomer piece. Here, take screenshots of it if you want. Ready? Here. Boom. 1, 2, 3. There you go. You could read the whole boomer piece if you want. I don't think there's anything. Yeah, that was the end of the boomer piece. So you can read the whole boomer piece there. I basically gave you the summary of the boomer piece. But anyway, there you have the sort of evidence behind it as well if you want. But anyway, if you think inflation is here to stay and the great moderation is over because of the boomer thing and or the stickiness of inflation, well, you probably just want to milk either milk bonds or just cash or straight cash and short, right? That's probably the position you're in. And so I actually think a heavy amount of positioning is on the side right now. A lot of cash is on the side right now. Yeah, retail's individual investors have started buying the dip. But in my opinion, the only way you can argue in the Nike swoosh is if you believe in number one. This is the volatile Nike swoosh that we keep talking about. That is a number one scenario right here. The doomsday scenario and inflation is here to stay. We effed, basically. So pick your side. or hey, or go 50-50. So yeah, there you have it. That is some of the madness that is going on. Check out the programs on Building Your Wealth down below. If it makes you nervous, get life insurance in as little as 5 minutes. If you want to buy the dip, sign up for Webull by going to metkevin.com/free and get yourself up to 12 free stocks. Free money, basically, for signing up to trade on Webull. All right. That's the doom scenario. Boy, there's a lot of content today. All right. Someone here donated money twice to ask me about UBS. I'll give you a little idea here. There is talk that UBS might be interested in buying Credit Suisse, along with a whole lot of other drama that we've got to talk about. What's really important to know about Credit Suisse potentially being looked at as an acquisition by UBS is, in my opinion, any private enterprise would have to get such a massive discount on these banks, because if they don't, guess what's going to happen? If one company buys a toxic company, the value of the company that's not deemed toxic yet plummets. Unless they got such a good discount on that deal that they basically made that company near worthless, and then they're getting their leftover clients. That's the only way that works out. Otherwise, that's how you get contagion. A good bank buys a crappy bank, and now the good bank becomes a bad bank. That's the disaster. Think about Bank of America and Countrywide. Bank of America bought Countrywide. You know how many lawsuits and crap they had to deal with for years after that because of the toxic bags they bought at Countrywide? That was an oopsie doopsie. And that's kind of what we're seeing now with Credit Suisse. It's starting, folks. Buckle up. Oh, yeah. All right. Let's do a little bit of Q&A. Yeah. Appreciate all the effort on providing content. This stuff takes a lot of research. I do my best to try to bring it over here. It's tough. But I enjoy it. Creating corruption out of control, personally staying with your Bitcoin, farmland, and gold. Go vegan. Wow. Somebody here says I blame Obama. No Nike swoosh. We're going off a cliff. The sky is falling. The comments are funny. Any bankruptcy advice? Nope. How much further with NAC asphalt? I think commodities are going to trend down. Don't drink and fly. I can drink as much as I want to. You know, I generally, I only socially drink, really. You know, I don't drink alone, maybe rarely if it's like there's a super stressful thing going on or whatever. I just like hanging out with people and having a drink. I was with Matt Reisinger. Shout out to Matt Reisinger, by the way. Oh, I'll show you a few fun things. Okay, ready for this? I'll just talk about Collabs. Okay, so I met Matt Reisinger the other day. I really encourage you follow Matt Reisinger on YouTube if you have not yet. Matt Reisinger is freaking the man of construction. He's awesome. Like, if you want to see how to build a house perfectly, he's the guy to go to. He is so cool. I love him. Big shout out to Matt Reisinger and his channel. Very, very educational content over there. We sat down for drinks at a place in Austin. Austin, by the way, awesome. Like, huge shout out to the people of Austin. Love Austin. Austin was really, really fun. I visited San Antonio and Fort Worth as well. I have some more learning to do in those areas, but that's okay. I think there's a lot of potential in Fort Worth, a lot of potential in San Antonio. I'll be posting sort of a vlog. I traveled to Texas alone this time, so I kind of did like a little selfie vlog of that for House Hack, the real estate tour. But yeah, check out Matt Reisinger. Really, really cool guy. Again, this was us outside of his house. Really, really cool guy. So love Matt. Again, Matt Reisinger on YouTube. Shout out to him. I also have a little spoiler for those people who watch Sarah Dietschy. Some people actually found my channel from Sarah Dietschy's channel when she covered my studio setup on her channel. And she has a little spoiler. So it's the Sarah Dietschy spoiler here. And I want to see in the comments, I want you all to speculate what the answer is to this, okay? So I'm going to play this here, and I want to hear what y'all think. Okay, here we go. Welcome back, everyone. I've got Sarah Dietschy here. This is so exciting, and there's
the beach.
The beach. So you live out here in Fort Worth, Texas. Why'd you move to Fort Worth?
Yeah, the DFW area is super great for just living a simple life. Everything is easy out here, right? It's not super expensive, even though it's getting pretty expensive. You know, finding a house has actually been more challenging than I thought. But everything else, like the rents, you know, we live in a decent townhouse for barely anything. You just have your own cars. I'm coming from New York City. I mean, I know that's basic.
You can get around,
yeah.
But you bought a townhouse out here at one point, or condo.
Yes, yeah. So we bought a condo, and all I'm saying is I am so against HOAs, y'all. Stay away from HOAs. I know they serve a purpose for having junk in your yard and stuff, but Texas is the land of HOAs. Okay. So I got burned pretty bad with that. But now we're renting super cheap, like a nice townhouse for $2,800 a month. It's like nothing.
That's awesome.
So rent's pretty cheap out here compared to New York.
Oh yeah. Are you gonna move back to New York ever?
So, you know, we moved out here to be with family. And I have had such a lovely time with my family. But we're realizing that our jobs, YouTube, it is helpful to have other YouTubers around us. So we're considering other places. I haven't even told my audience that. But I'll say here, we're considering other places.
Ooh, okay, okay. All right, other places with YouTubers.
Yes. Okay. So there's maybe a couple places.
Yeah, not too many of those places. Yeah. A place Would you leave a place with no income taxes?
I would.
Oh.
That is how much we want to be around friends.
Oh my gosh. Okay. Well, we'll have to leave the tease there.
Yeah,
Okay.
yeah.
Well, when are we gonna find out? When will the world know?
This summer. This summer.
This summer.
Yeah,
Stay
yeah.
tuned. Go to Sarah's channel, subscribe, and find
Thanks
out
for visiting.
where's she leaving Texas for. All right. So that's an interesting little append there, because Sarah Dietschy is actually, she told me a lot about Fort Worth, Texas, which was really useful for House Hack. Obviously, I met multiple realtors out there as well. I'll be posting that video. But where do you think Sarah Dietschy is leaving to? So Sarah Dietschy is a YouTuber, covers tech. She's in the tech space. She moved to Texas from New York, and now she's going somewhere else. Where do you think she could be going? Somewhere where there are YouTubers and potentially a state income tax. It's going to be really interesting. So stay tuned for her announcement on that. But seriously, huge shout out to Matt Reisinger again and Sarah Dietschy. Yeah, some people are saying Vegas. Let me give you a hint. There is no state income tax in Vegas. And she's open to the idea of going somewhere where there is a state income tax along with YouTubers. So we'll have to leave it there. Yeah, somebody here writes, the Credit Suisse. Okay, so somebody's asking, why is the Credit Suisse stock important? The stock is important because you could get even more downward pressure when the bondholders convert. Some of the bondholders get forced to convert into equity, which leads to even more downward pressure on the stock. And if the stock goes so far down, that is an asset on other banks' balance sheets potentially, and then you that's how you start seeing contagion. No. So anyway, there you have it. Thanks so much for being here, folks. Really appreciate it. We'll see you.